Ever wondered what to do when your business is hitting a cash crunch? Your business might be growing in revenues and customers, but nothing seems to be hitting your bank. Welcome back, hustlers, to another episode of Just Hustle. In today's video, we talk about 2 ways to raise funds for your hustle. If you're not subscribed, please consider doing so. It helps push out content just like this. So hit the like and subscribe button and let's dive right in. Number 1, debt financing. To make a fancy term sound incredibly simple, if you don't have the cash, take it from someone who does. Simple enough? Banks run on the business of loaning out money. If your business has a good track record or even some assets, you can use them as collateral. And you'd honestly be surprised how many banks and investors themselves would reach out to you to take some cash off their hands. Let's roll in that cash. Whether you need the money to start a big project or solve a small cash hiccup, debts come in all shapes and sizes. Some can be long-term debts where monthly payments need to be paid out, or short-term debts where credit cards come to the rescue. The kind of deal or the interest you get charged by the lender is based on how good your credit score is. You know, the thing that we have talked about in some of our past videos, and the kind of assets you can put up for collateral. Your business will have to fork out interest payments based on your credit worthiness. And if the business fails to pay, then you, as a personal guarantor, would be entitled to repay the amount, and the bank has the rights to seize your personal assets in the process. Hence, it's important to separate yourself from the business by forming an LLC. Now, debt may sound like a scary thing, but the rich have made their fortunes using debt. And you can too! If you don't believe us, click on the link below to check out our video on 5 ways the rich use debt. It's go big or go home. Number 2, equity financing. This is what most newer startups are doing, and it's working out to be quite effective. We haven't forgotten you guys asking this question. What do you do if your business is just starting? Or maybe your sales have just started, but you're not making the rain money kind of profit to afford interest payments. Guess what? Banks won't loan money to someone who doesn't have a credit history or any personal guarantors or assets. Nobody gives anything without getting something in return. And when you don't have cash, you can always offer a part of your future cash-making machine, which is exactly what equity is. If you are trying to grow fast and stay competitive, but aren't making money yet, equity financing is the way to go. You may not own 100% of your company, but with the extra cash to expand and without the financial stress of having repayment obligations, your company will go where it needs to be, which is like the Dogecoin holder said, to the moon! There are different places you can raise money from, such as your friends, family, angel investors, venture capital firms, or even the government. And while in debt financing, the lenders are only concerned with the repayment of the loan, but equity financing, the investors coming in provide an added advantage in the form of their knowledge, expertise, and the contacts that they can share that help in the growth of the business. Investors know that the greater the height the business scales, the larger will be their return. Oftentimes, they also become sources for future funding. However, you need to ask yourself what portion of the company you are okay parting with, how much control of your business are you okay giving to somebody else, and what type of investors are you seeking, since this is usually a longer commitment than debt financing. Most businesses at some point of time will need to reach out to debt in order to grow to the next level. What you sacrifice in order to make that happen is dependent on where your business is and where you wish to take it. Sometimes, having a smaller equity in such larger business is better than being a complete owner of a cash-crunched smaller business. We are going to leave you with this one question, and we'd want you to comment on your answers below. Would you choose to be 100% owner of $1 million company or a 60% owner of a $10 million company? If you have learned something, please like the video by giving it a thumbs up, as this motivates us to share more informative content, and do subscribe to our channel. Until the next video, just hustle.